So 95% of traders lose money in the trading game. Shocking statistic, but is it true? And also, what can you do about it as well? Let me explain in this video. Please like and comment on the video below. That will allow me to produce better quality videos and more of them in the future. If you're interested in learning to trade successfully on sports, then why not visit the BetAngel Academy, where we have more detailed videos. So, 95% of traders lose. Is that a true or false statement? Well, yes and no. It depends how you want to look at it. But the first point that I will make is that 95.67512345% of statistics are made up on the spot. Who knows if that is actually a true statistic? Because I suggest that it is true, but it probably also isn't at the same time. And I have no idea where that comes from. And if you have ever seen any report or anything that indicates that percentage, then comment below and I'll have a good look at it and tell you what I think of it. Because when I was researching this video, what I did was I went off and looked to see if I could find some evidence that 95% of traders lose. And it seemed a bit wishy-washy. There was no definitive source. But also, it depends upon the way that you look at this particular problem. So I went off and looked at some brokerages in the US, and they have to publish information on client sort of utility, basically how many winning accounts and losing accounts they have, and exposure and stuff like that. You can get it from the regulatory body. So I actually had a good dig around and found some information within there. But the interesting thing was it didn't come out anywhere near 95% of traders losing. But part of that was about what timescale you decided to manage it over. So, yes, 95% of traders do lose if you extrapolate it for long enough. But they don't if you, it's like, over what period of measuring? Are you saying 95% of traders lose over 1 day, 1 week, 1 year, 10 years, 5 years, 100 years? Because ultimately we're all going to die. So I suggest that the failure rate is 100%, because one day we will all pass away. And I suggest that that would be regarded as a 100% loss. But, putting a figure like 95% up without actually qualifying over what time period tells you absolutely nothing, for the following reason. When I was looking at the brokerage reports that were filed with the SEC, generally the figures were coming out that over 1 year, somebody trading a foreign exchange account you'd probably get about 30 to 35% of people will make money. So you could tell that in fact 60 to 70% of people were losers. So in fact that figure should have been 60 to 65% of traders lose. However, if you extend the time period out, then that tended to increase the number of traders that ended up losing. So if you look over a 5-year period, only 15% of retail forex traders actually ended up making money. So 85% lost if you looked at their account over a 5-year period. So that sort of makes sense, because obviously, it does to me, and I'll explain why in a second, but basically the longer you go on, the less chance you have of surviving by luck alone. So if you look at my career, I have lasted, for want of a better word, 18 years. So I'm obviously doing something very, very right to be able to do that. I actually, at this moment in time, apart from if there's a structural change in the industry, I don't see how that will change for me. I think I could go on for a long, long time without a fear of falling into that losing pile. But structural change could radically influence that. But let's have a look at it from a couple of different perspectives as well. So if you are trading, you're going to win or you're going to lose. So if you're trading in a zero-sum game, then basically it's a battle between you and everybody else within that particular market. Now I think that if you look at a lot of trading markets, you could describe them as zero-sum, but they do have economic utility. So a foreign exchange trader is trading prices on a market against other people, but sort of Bill and Jenny, who are going to go on holiday to the US or something, will get a better exchange rate because of that, because the exchange rate is going in their favor and they're buying at an optimal time. If you look at your average punter that wants to stick something on at 10 to 1, he can go on an exchange and get 15 to 1 because somebody's willing to bear the risk. So I think whether you define it as a zero-sum game or its economic utility as a zero-sum game depends upon your individual viewpoint. But I think that the exchanges and traders do add value because they're offering better pricing. And so I think there's a direct utility there. So I think that if you cynical and classify it as a zero-sum game, there is utility there. It's not as though it's just a trader takes money out of the market. However, you have to compete against other people, so you're more likely to lean towards that zero-sum process there, because you're going to have to win money against another trader perhaps. Maybe you're not going against a punter. Maybe that's not one of the things that's happening within that particular market. So putting all of that to one side, let's look at investing and see, because investing definitely isn't a zero-sum game. You give money to somebody here, it gets invested and then returns to you at some point within the future. So you need to see some sort of return on that. So say that I put money into an investment. It could be a house, it could be a stock, it could be a business, it could be anything. I expect to get a return on that, perhaps on an annual basis, a dividend, or an interest payment or something like that. So when we look at it from that perspective, say I get a 5% yield. If I hold that investment for 20 years, if you multiply 20 by 5, you get 100%. You will get your entire return back. You will not lose money. If you hold something that is yielding 5% a year and it's going to yield it for 20 years, you can't lose money. So the number of investors that lose money over the longer term, you actually find you get the opposite effect. You get more and more likely to make money if you're investing as opposed to trading. So yeah, the effect flips around the other way. The longer you are in a zero-sum trading market, you could argue that it's more likely that you won't make money eventually. But when you're investing, it's pretty much flipped the other way around. So yeah, there's a big difference between the two there. But probably the biggest difference is I bought some stock 20-something odd years ago. I paid $20 to be able to do that transaction. And that stock is worth a lot more now, and I have to pay $20 to exit the transaction. So I paid $40 for a significant investment, and that's it. That's all that I have to pay. So the yield I get from that investment and the return that I get on the basis that I should be able to sell it for a higher price means that, in fact, the transactional costs behind that investment are absolutely minimal. However, look at trading though, and it's a completely different kettle of fish. If you look at those foreign exchange traders, they're going to have to pay a transaction on the way in and a transaction on the way out, and that's what kills them. That is where the loss is coming from. If you trade any market that's efficient, you win as often as you lose, and the two net each other out and you break even long term. And that's more or less what you find in a lot of markets, including the sports trading markets. If you trade in and out of a position, over time it will all balance out and you'll neither win nor lose. It'll basically just end up at break even. So why do so many people lose? It's because of the transactional costs. It's the frictional costs within the market that are generating the loss. Unlike an investment where I paid a $40 round trip, when you're trading, every time you transact a trade, you're costing yourself money. In sports markets, it's slightly different, but this should tell you why I ended up trading rather than traditional betting in sports markets. Because if you win £500 on an exchange through an outright bet, you're going to have to pay £25 worth of commission. But let's say instead of just winning a £500 bet, let's just say that I actually traded it and I made £50 on that with my £500 through trading rather than betting. I only pay a commission on that particular winning trade. I actually think it was a bit of a flaw in the way that the exchanges were created, because they said, okay, you only pay when you have a winning bet and you don't pay any commission when you lose. But of course, when you trade, that means that if you trade to a reasonably high strike rate, then you only pay commission on those winning trades, and that is going to be absolutely tiny. And that's why trading is so effective, because the transactional costs are so small. We paid 5% on a £500 bet, but we could actively trade the market and make a £50 profit on that particular market and only pay a small amount of commission on our winning trade. And if we cock up the trade, for want of a better word, and we don't make any money, we pay no commission. So one of the biggest benefits that you get within trading is that the transactional costs are so low. So if you trade at random, you'll get random results, you'll break even. But even if you do win and you have to pay commission, the costs are so little that generally it doesn't add up to much in the overall scheme of things. So your objective, your mission, should you choose to accept it, is not actually to trade profitably, it's just to trade profitably enough to overcome your minimum transaction costs. And if you do that, you'll be nowhere near being one of the 95% of traders that lose money.